Hello, my friends. Today is July 1st. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we're going to talk about the prospect that the Fed is again behind the curve. Secondly, we'll talk about China's hidden foreign reserves, which may be enormous. And lastly, we'll talk about what's happening with the USD JPY, which appears to be hitting some pretty key levels. Okay, first, starting with the Fed. Now, the big news from my perspective this week was that the third revision of first quarter GDP was again revised higher. It printed at 2%. Now, this is interesting to me because it shows that monetary policy so far hasn't really been super effective in slowing down growth. The Fed looks at the world where you have a potential GDP growth, and if you're growing faster than your potential GDP growth, that means you're growing above trend, and that's inflationary. So a lot of what the Fed has been trying to do over the past year or so has been to slow things down to make sure the economy is growing below trend so that they can get inflation under control. The Fed thinks that the potential growth for GDP, trend growth, is about 1.8%. So at 2% growth first quarter of this year, the economy continues to grow above trend despite the Fed's efforts to slow it down. So this tells me that, whatever the Fed is doing, it's not working as well as they thought. And we've talked about that before. They show that in their projections. Now, this past week, there's also this new financial index that was revealed by the Fed. In this financial index, these economists from the Fed give you a view of how they're looking at financial conditions, whether or not they're tight, whether or not they're loose, and what the impact on growth will be. According to this new financial index, financial conditions are tightening and it's slowing growth. Now, I make this point because this is very different from the other financial conditions indexes. So common financial indexes like those published by Goldman Sachs or the Federal Reserve Bank of Chicago actually show that financial conditions are kind of loose. And when you look at that, plus the actual economic data, you have to come to the conclusion that, the world is not behaving the way the Fed thinks it is, and the Fed might be behind the curve a bit. Now, there's a lot of people at the Fed who think that, monetary policy takes time to work through the economy. There's a lag here. And you have tons of people on Twitter who are talking about, recession is imminent, it's coming. And those people have been saying the same thing for over a year now. But when I look at the data, I'm getting the sense that the recession occurred and now we're actually reaccelerating again. So this is how I look at this. If you had financial conditions that were tight, you would expect, at least minimum, expect two things. You would expect that sectors that are really interest rate sensitive, like housing, to slow down, and you would expect financial assets to do poorly. Now, let's start with housing. Now, last year, as you know, the Fed tightened and housing took a dive. You had house prices go down, mortgage rates go up. A lot of people are complaining on the internet about this. But when you look at the data, it looks like house prices stabilized in the first quarter of this year and began to really accelerate. If you look at housing starts, which is a leading indicator showing how much new construction is being started, it went down a lot last year in line with higher mortgage rates and all that, stabilized and is now rocketing higher again. So it seems like, the tight financial conditions had an impact. The economy shook it off and continues to accelerate again. And now let's look at financial asset prices. Last year, obviously, it was a bad year for both stocks and bonds. This year, it seems like stocks only go up. Actually, it seems really concerning to me. So if financial conditions were really tight, I don't think you would expect stocks to go up every single day. So now, if the Fed is looking at this new index, thinking that we're tight, but then economic data suggests otherwise, other financial conditions suggest otherwise, then I think we're in a situation where the Fed is, again, behind the curve, and they might be forced to catch up a bit. So, I know they penciled in 2 more rate hikes by the end of this year. I think there's upside risk to that. And I think from what I'm watching the price action this past week, there's a little bit of indication that the bond market is becoming to realize that, the Fed doesn't have things under control, and we might see yields kind of steadily move up again. It looks like they've been consolidating. But as you guys, if you follow me enough, you know that my view is that yields are going to trend higher for these coming years, and we should be above 4% by the end of the year. Okay, let's talk about the next topic. So the next topic has to do with China's foreign reserves. It's based on this piece by Brad Setser, who is one of the world's foremost experts on these flows, and in China in particular, on their foreign reserves. So let's give a little bit of background first. Just what is a foreign reserve? So let's suppose that you're China. China is the workshop of the world, and they sell a ton of stuff to countries all over the world, not just the US, but to Europe and to other countries as well. And so they make a whole lot of money denominated in foreign currency like dollars. So they usually keep these dollars. So, again, they're selling a lot more than they're buying from abroad. So they're accumulating a lot of foreign currency, a lot of dollars. And they usually keep this in what's called a foreign reserves fund. It's held by the People's Bank of China. It's like their rainy day fund that they can use to, for example, lend to their commercial banks when they need dollars, or maybe stabilize their currency. So China uses a quasi fixed floating soft peg. And so at times the Central Bank of China intervenes to steady the currency there. Now, here's a curious thing. China continues to sell tremendous amounts of stuff to the world, continues to earn lots of foreign currency. But if you look at official data on their foreign currency reserves, it's been plateaued around $3 trillion for the past few years. Oftentimes, so just another point, so these foreign reserves are usually held in sovereign debt. So if you oftentimes hear about China being a very large holder of treasuries, or at least agency MBS, it's because they have over $3 trillion in foreign reserves. The exact breakdown of that is a state secret, but it's commonly thought that maybe around half of that is in dollars. And among the dollars, a lot of it is held in stuff like treasuries and agency MBS, which have no credit risk. Now, how do you resolve this puzzle where you continually have a current account surplus, but your foreign reserves are not growing? So Brad takes a look into the data and finds that, if you're China, you can actually do a lot of things to kind of quote unquote hide your foreign reserves. This is because in China, the government basically controls everything. So for example, one of the ways the government can go about, hiding its foreign reserves is to put them in the commercial banking sector. So what Brad sees is that if you look at the data of the large commercial banks in China, which are, of course, controlled by the government, you'll see that they hold tremendous amounts of foreign currency assets. So one possibility is that the People's Bank of China gets all these dollars from trade, but instead of putting them in their foreign reserves, they're putting them in the commercial banking sector. So it doesn't show up in their foreign reserve funds. And you can see that in the data. It seems like the foreign currency asset holdings of the commercial banks continue to increase. Now, the second thing you can do is you can put it in these policy banks, or, and lend it to other people. Now, we've all heard of China's Belt and Road Initiative, where China goes around to developing countries, let's say countries in Africa, and lends them a whole bunch of money to go and build bridges and stuff like that. Now, one curious thing is that these loans are actually in dollars. So you can think of it as China having a whole bunch of dollars, but instead of just putting them into treasury securities, they funnel them into these policy banks, these initiatives like the Belt and Road Initiative, and then go and lend them to other countries. It doesn't show up in China's foreign reserves, but it's basically held in another form. Now, Brad finds that if you look at all this, the actual foreign reserves that China holds could be twice as high as the $3 trillion we see in the data. So maybe $6 trillion worth of foreign reserves, and that's absolutely enormous. And that has implications with how we think about what China might be invested in and whether or not there's a potential for financial distress in the Chinese economy. Now, over the past few months, we've seen that the Chinese currency continually depreciate against the dollar. And there have been some concerns that maybe China's growth is really not good. There's financial instability. And so maybe the country might lose control of their currency since everyone wants to get money out of the country. So, selling RMB and buying dollars or something like that. Now, if China actually has $6 trillion in foreign reserves, there's really absolutely no worry about this. $6 trillion is enormous, and they can easily manage any outflows. And of course, in addition to that, they also have capital controls. That is to say, they can forbid anyone inside the country from taking money out. So it seems like China is, in terms of this current account stuff, is pretty rock solid. There's really no concern of an outflow or some kind of balance of payment crisis, which was kind of silly to begin with. And I think it's also worth noting that this is kind of a huge political problem for China because, as we know from the episode with Russia, that if a country behaves in a way that makes the U.S. unhappy, the U.S. can ultimately freeze their foreign reserves, effectively confiscating it. So Russia had some money in treasuries and in dollars, but then after the sanctions, they lost access to all of that. And there's even some news that suggests that, maybe the Western countries would take that money and give it to Ukraine. Now, if you're China and you have $6 trillion and maybe you're not the best friends with the U.S., well, that's a huge problem. That kind of gives the U.S. a lot of leverage over you, because if you behave in a way that the U.S. does not like, well, maybe they'll freeze all that assets, and that's a lot to lose. So I think there's going to be added urgency for China to try to get out of this somehow, and it's not easy. Okay, the last thing we'll talk about, it's what's happening with the USD JPY. So USD JPY, obviously the exchange rate, how many yen it takes to buy a dollar, has been steadily, the yen has been depreciating against the dollar. So USD JPY has been rocketing higher. And it's easy to see why. So again, throughout the world, interest rates have been rising steadily. Fed is at 5%. Bank of Japan still at -%. Actually, they haven't raised interest rates at all. Now, there's been a lot of speculation from the investor community thinking that, Japan inflation is above their target. Maybe they're going to be raising rates soon, or at least get out of yield curve control. Now, we just heard their new governor, Uedo, talk this past week at Centra, and he says that that's basically not going to happen.
Governor Ueda, when it comes to the inflation path for you, I know you'd like to see it continue to rise from here, right? What would it take for you to really strongly consider abandoning the yield curve control and negative rates?
So we have a forecast or projection of inflation path that looks like it's going to go down for a while toward the end of this year on declines in import prices, and it's spilled over to domestic prices. And from there on, we are forecasting some increase in the rate of inflation into 24. But we are less confident about the second part. If we become reasonably sure that the second part is going to happen, that could be a good reason for a policy change.
If you see a steady increase.
And I also note that this is the first time I heard the new governor speak, and he speaks English well and has a pretty good sense of humor. This joke was my highlight.
Governor Ueda, do you worry about the lagged impacts of their policies on the global economy and on your economy?
Oh yes, but for ourselves, we haven't had any serious monetary tightening for 3 decades. I was a board member of the BOJ 25 years ago. Then the policy rate was about 20, 30 basis points. Wow. Now, minus 10 basis points. So,
And it doesn't sound
Yeah.
like it's changing anytime soon.
so in terms of that, the lag in the effects of monetary policy could be at least 25 years.
So monetary policy could take a long time to work. Okay, so Governor Ueda is basically saying that, inflation is transitory, so I'm not going to do anything about this. Now, this may sound like a green light for the yen to continue to depreciate against the dollar, as it has been, but we're also approaching levels where in the past, the Ministry of Finance in Japan, who is the organization that actually controls the currency, is trying to slow it down and might intervene. So the way that they would intervene, of course, is that they will sell dollars and buy yen. So that makes the currency stronger. Now, the last time they did this, it led the currency pair to basically stop in its tracks and reverse. So as we approach this level, we want to focus on whether or not this intervention will happen again. So this matters to the broader market in a couple ways. One small way and another bigger way. A small way, of course, is that if you have to sell dollars and buy yen, where do you get those dollars? You have to sell treasuries, usually. So if you're selling treasuries to get cash, then that's some small upward pressure on yields. It really depends on how big the intervention is. It's usually not enough to make a difference for yields. The second thing that's more interesting is that usually USD JPY is like an overall risk indicator in the markets. If you look at what's happening over the past few months, yen depreciates, Nasdaq goes higher. This is a relationship that we've seen on and off over the past few years. So if you have the yen, again, stopped and strengthening, that is to say, reversing its trend, USD JPY going lower, you could see that being a pullback for the rest of the risk asset markets as well. Now, it's an interesting relationship. One way that I think about this is maybe there are investors in Japan that take their money out of Japan and buy risk assets in the US. So when they do this, though, and say the Nasdaq goes up, well, they're making money on the appreciation in Nasdaq. And as the yen depreciates against the dollar, they're also making money on the FX trade. So it's kind of a double play. So it's been a really good trade if that's what they've been doing. But if the yen does not continue to depreciate, maybe they'll cut back on that. Okay, so that's all I've prepared this week. Thanks so much for tuning in. Happy 4th of July. And as usual, if you're interested, if you like what I'm producing, remember to like and subscribe. And please check out my blog, fedguide.com. It's a subscription service, but it provides my latest thoughts on the markets. And also check out Central Banking 101 if you like free courses on how the macro world works. All right, talk to you guys next week.